And welcome to the Beyond the Dollar Signs podcast with your host, Mark Taylan. Mark, how are you?
I'm great, Bill. It's good to see you.
It's great to see you as well. I like this topic because, as I was telling you right before we started recording, I have this conversation with myself every day, at least once a day. And I look at the stock market and I think, boy, it's doing so well. Should I get out of this market? And then it's immediately followed by, but if I get out of this market, what's going to happen? Because can I get back into this market? And it gets to be a whole emotional ball of blah, for lack of a better way to put it. And I would imagine that this is a pretty common emotion at this point. There's a lot of confusion. So bring some clarity to how you see these markets at this point. Mark, should you get in? Should you get out? Or how should you approach them?
You know, everybody has different goals and objectives, and everybody's in a different spot in their lives. It's certainly a euphoric feeling when the markets reach all-time highs, and certainly that's what we've seen this year, right? We've seen a pretty steep drop sometime around April. We saw about 40 days of a market drop, and then a quick V-shaped recovery, and we've seen a unprecedented move to the upside. You know, you see on the media, we're crossing all-time highs today in the NASDAQ and the Dow. A lot of the big technology stocks, especially names like NVIDIA and AMD, all-time highs. Every day you open your phone in the morning, AMD hit an all-time high today. And it's very euphoric because you're watching returns in a day that are really good for a year, right? Normally when you think about markets, what are the averages of the S&P, for a 10-year time frame? 7 to 10%. And you can see some of these stocks when news comes out up that much in a day. So and you're wondering, how sustainable is this? Even in a financial advisor that's been in the market and been investing in license for 20 plus years, those thoughts would go through my mind as well.
Well, yeah, it's funny because there's two sets of conflicting emotions for, I think, a lot of people. One is the fear of missing out. And the other one is, but if I get in now, oh man, I'm going to be screwed because I just bought high and I'm going to have to sell low. So how are you counseling your clients when they come and sit down and say, Mark, how should I be looking at this? How should I approach this?
If it's an existing client, it's really about discipline and having that long-term approach. I tell you, for clients that I've managed their assets for more than a decade, it's interesting because, most of them are very comfortable in retirement at this point, and they catch the news. They don't watch it daily, but they do catch the theme of what's happening in the markets. And then when they come in, they want to know how we're doing. And I'll tell you something that's really fascinating to me as an advisor, and that is that the market's up 10%. Yeah, they're pretty happy. And I'm saying, we're beating what our target was. Maybe that target is 7 to 8%. And I sit with them and say, we're up 10% this year. And they're happy. You can tell emotionally they're relieved that, and excited that the markets perform well and that we're on track. On the flip side, if we're down 2%, which is normal, you can be down 2% in a day. Or more, depending on how you're invested. But the losses feel more painful than the gains, right? It's just that emotional response to risk aversion, right? I'm at the point where I don't want to lose anymore. I don't want to lose money. I don't want to be in harm's way. So the thing that you talk about of fear of missing out, I find is very, it's an emotion that really can drive behavior often, right? It's like, wow. And maybe you didn't participate in the rally, and I've seen that as well, right? Where clients have said, just as you were talking as we opened the podcast, should I cash out today? And maybe they cashed out where they cashed out and they made money, but the markets continue to run 20% more. Frustrating,
it's a terrible place. Yeah, it's a very terrible place to be.
You didn't now remember. you didn't lose any money. You made money on the
you still
trade,
made
right?
money. Exactly. You still are ahead.
You
yes.
still made money. Yeah. But it's hard to think and go, wow, the market went up 20% more. If I could have, should have, would have stayed invested, maybe I would have made more money. And so there's that camp of people that, were disciplined to say, hey, I've got a point that I've made enough money. I feel comfortable. I'm going to protect these gains, right? And their cash out.
Yeah.
Now, on the flip side of that is, what did you do when you cashed out, right? If you sold and took that profit, what did you do with that money? Is it sitting in cash? Did you diversify that asset and buy something that is different from what you had? And maybe that as well went up, not as much as what you sold, but it's a matter of how you repositioned your portfolio with that money. So I think that's some of the things that I observe.
It's very difficult to stay disciplined in a market. Just speaking as a guy who covered business and financial news in the stock markets for several decades, it's very tempting to think I can sell out now because it's high and I know it's going to come down. And when it comes down, I can buy it after it comes down a little bit and I can get back in the market and I can do really, really well. The problem with that is it's kind of a myth because there are very, 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 very few people who get the timing right.
You bring up a topic, and we call that in the industry timing the market, right?
Yep.
And timing the market is very difficult to do because if you think about that, you not only need to figure out when to buy or when to buy, but
right.
you also need to figure out when to sell.
Exactly.
And so the challenge is that you're making a decision that's either I'm in or I'm out. And when do you get back in and when do you get out? And that's so difficult. I've actually experienced clients that took that approach prior to the financial crisis in 2008. Okay. So they felt that the economy was going to drop. They had the insight and the foresight to say, I'm going to sell, and they went to cash. And they missed 2009, wow. The S&P 500 was down 53%, right?
Mm-hmm.
And so they missed all of that. They must have felt like they had the crystal ball, right? They knew they had the secret sauce and they were on top of the world because, their portfolio was in cash when the markets are dropping 50%. What do you think happened so when I met this client, and it's probably about 5 or 6 years later, right? So we're talking about 2013.
Okay.
And I asked them, I said, what do you think? I said, well, when did you get back in? What do you think their response was?
They probably didn't.
Just get. You're exactly right.
They probably
I'm still
didn't.
in cash. They're still in cash this whole time.
Wow.
So really, they were fortunate to be in that position. But again, it's hard to make that decision and again, when to sell, when to buy back in. What's the strategy? Would they have been better off? Number one, sticking with it. It's difficult because most investors can't stomach a 53% drop.
Well,
because
nobody
the psychology.
Can. Nobody. Yeah, let's be fair. For everybody listening, if you think you can stomach a 53% drop, go watch your portfolio drop over half. It's not fun. Nobody deals with that well.
What do you think in their mind when people have a risk tolerance level, is what I call it? So you take $1 million, that $1 million drops 20%. That's usually the risk level people have, somewhere around 20%.
Right.
Now you go to 30%. So your $1 million is 700,000. You go to 40%, you're at 600. Then at the peak of the drop, 53%. So your $1 million is now under $500,000. So there's points where people will say, if it gets to this point, I'm selling. I can't, because it's like catching a falling knife.
Yes.
And that falling knife, it's like you feel like it's going to go to nothing. I want to have something left over. And that's why investors don't realize the averages that you see. People say, oh, I can 8 to 10%, that's great, but they don't understand the roller coaster ride of being 100% invested in stocks, right? And what that risk could potentially be. So we haven't seen that for a while. And I always, in my mind, because I've experienced it myself, I've experienced this with clients through 2001 through 2008 and, the pandemic and all these things in between. I know what risk is and how clients react. We actually use what we call stress testing software that shows them if your portfolio is invested like this today, and we went through these market cycles like a 2008, a 2001, how would you have performed? And I show them really, this is how this portfolio, exactly what you have today, would have performed. And they see, like, I would have lost 30%. I'm 100% invested. I would have lost 50. And so it gives them a reference point to figure out, I can handle this risk. This is what it's going to be. And so I think that really is helpful when you stress test portfolios in that manner. And it's just not percentages. I'll tell you, clients that we have that are multi-million-dollar clients, $3 million, $5 million in assets invested. A 5% drop on a $5 million portfolio, Bill, is $250,000 in a day, right? A 5% drop. So when you think of it percentage-wise, yes, but I also point out the dollar amount. I want you to imagine opening up your statement and realizing this is what's happening, right? So it's a tough, it's tough to manage that, the emotions, because I think people, investing is emotional. But then you've got your logical side and you've got your emotional side. And most likely the emotional side takes over, right? Because the fear is so strong.
No, it's true. I mean, and the thing I used to repeat to myself all of the time when I was covering markets is that there's a buy side and a sell side. The buy side guy or gal is like thinking, this is the time. I'm going to get in. I feel good about this. I like this investment. On the other side of that equation is the sell. And the sell person is like, I've had enough. I'm out of this. I'm either nervous or I've made enough money. They've got their reasons for selling. So that there is a dynamic that's in place in the market. So I think it's helpful to remember, because without them, they wouldn't work. So there's always somebody willing to sell it and somebody willing to buy it on most days, unless you got one of those crashes where you got a lot more sellers than you do takers, So what do you do? I mean, I like the idea of creating an insight for people so you can make it concrete, where you say, this is what your portfolio would have done. Are you comfortable with this? Do you see what this is like? Does that open a lot of eyes? What's the reaction from your clients been?
I think the reaction is there is a response to that. Right. There is a response because that's what I'm looking for. I'm looking for the emotional and the logical response. And that really guides me as an advisor to say, this is the appropriate risk portfolio for you. Right. And certainly you have to balance that with goals. And so if the client needs 8 to 10% returns, they're not going to achieve that by having 90% in bonds and 10% in stock, right? It's very unlikely in the long term that a portfolio that conservative is going to average 8 to 10%. And so there's always it's always balanced with what's the right portfolio to achieve that return. And maybe they're not comfortable with that. So then we need to go back and look at, why do you need 8 to 10% return? What is driving that? Is it an income need? Is it a goal that you want? And so those are the things that are part of the whole process of, determining what the right strategy is and showing them the discipline needed, the type of risk to expect. And I think that's important to have that clarity. So they have that peace of mind when the markets drop, they're prepared. And sometimes, I've done this for my career. And when I first started in the early 2000s, it was, the markets are going to be down someday because we're going to work together for a long time. Maybe 10 years, maybe 20, maybe longer than that. But one of these times in that time frame, the markets are going to be down. And I'm going to come to you and say, it's time to invest more money. This is an opportunity. And you're going to say, I don't know. I'm uncertain about that. I don't think it's a good time. But I'm gonna come to you when it's difficult to invest at a time when everybody's running for, and selling. That's the time. And if you think about, one of the greatest investors of our time is Warren Buffett, right? What does he say, right? When there's blood on the street, it's time to invest.
Yep.
Right. Or the herd mentality. If everybody's going one direction, maybe that's a sign that maybe we need to rebalance and think logically. So a lot of psychology, a lot of trends, but it's really comes down to discipline.
Yeah. Well, how do you get them to maintain their discipline? Your clients, I mean.
It's investing and doing the work with them in the beginning, really making sure that all the things are in line, that we're actively, monitoring the portfolio, we're rebalancing it at least on an annual basis. What you'll find today is many people haven't rebalanced. So if they've had that traditional 60-40, 60% stock, 40% bond portfolio, the markets have been so good that now they probably have a 70-30 or an 80-20. So you have a really big imbalance of stocks to bonds. And so it's time to rebalance that. And not necessarily to bonds or other assets that you can invest in to balance that risk. Could be real estate, alternatives. There's a lot of things. But I think this is a critical time where you have the opportunity to take some of those profits that we've made and invest it appropriately and reduce the risk. Yeah.
I hesitate to say this because, well, I'm, partially part of the problem, but, for years as a reporter covering the financial markets, you never get anybody's attention by saying something calmly. There are headline writers out there who write headlines, headless body and topless bar. Immediately, you're like, whoa, they do that in the financial markets as well, right? They're like, there are headlines designed to capture your attention, get your attention, and hopefully make you watch because you're like, well, something's going on here. I've got to watch and see what's going on. Do you talk to your clients about taking all of that with a grain of salt, maybe?
Oh, I'm glad you brought that up, Bill. It's so important. Remember, headline news is created to, I think, for an emotional reaction, or nobody's going to watch. And so I watch the news in the morning because my anticipation is I may get a call because somebody watched it during coffee in the morning. They heard something about the markets, and they're going to come in and they're meeting with me, and they're going to ask me that question. How do you feel about tariffs? Whatever was on the news. And my other clients are, and so I certainly expect that, but I always tell my clients it's headline news. It's meant to create a reaction. If the markets if you turn on and it's red, I tell you, some of my best clients over the years, they said, "Hey, Mark, good morning. Should we buy anything?" Number one. And number two is I watched that and I turned it right off. I turned on the TV. I saw a bunch of red in about 5 minutes. I said, I can't take it. And they turned it off. And so they said, is there any opportunity? And by the way, I turned the news off because it's all negative today. Right. So I think it's about conditioning and setting that expectation. So
it's a smart
thank you
client.
For bringing that up.
No, it's a smart client.
Yeah.
And I'll tell you something. I'll let you in a little secret. When markets go really bad, people do turn off their TVs. They do. They're like, I'm not watching anymore. They just turn them off.
Yeah.
Because, at that point, you're in the middle of something you have no control over. It's something that's going to happen whether you want it to or not. So
that's right. Right.
So we've tuned out the hype. We've stayed disciplined in terms of our investing and stuff. I love the idea of the portfolio insights. Is that something unique to you in terms of doing that? Is it?
Well, it's not, I don't know if it's unique to us, but it's something that we really believe in is stress testing the portfolio and giving clients that insight. So we have a process that we've developed over the time I've been in the business. It's called Wealth Path. And that's part of one of the steps that we take is the analysis and the monitoring of the portfolio from a risk standpoint.
That's great. So if anybody's listening to this podcast and is curious to know more about this because you're not a client, reach out to Mark. And Mark, if they wanted to reach out to you, how would they get a hold of you?
Yeah, so the best way to reach us is by phone or email. We love to do, it's an advanced age of technology. So Zoom meetings are fabulous these days. Or of course, we'd love to see you in the office. But to do that analysis, please reach out. Mark at privateclient360.com. You can find us online. Our information will be in the podcast.
Yeah, if you're listening to this and you're feeling a little anxious, it's in the show notes. So if you're driving, you don't have a pen in your hand right now, you can always go back and pick that information up. The other thing that you can do as well is, if you are not a subscriber, is become one. That's easy. All you have to do is hit the follow button. And the beauty of that is the next time Mark drops a new episode, you'll be notified and you can give that one a listen as well. I would also ask, if you like this podcast, would you tell people about it, please? Word of mouth promotion is an invaluable tool of promotion because it's coming from somebody you know, as opposed to something out on the internet that you have no idea of what it is or what origin it came from. People, talking to people, it's a good thing, as a matter of fact. So until next time, I'm Bill Tucker. On behalf of Mark Taylan and everybody at Advisors 360, thank you for taking the time to listen today. We'll catch you next time. Thank you for listening to Beyond the Dollar Signs Financial Clarity. Click the follow button to be notified when new episodes become available. Visit our website at advisors360pwm.com or give us a call at 408-778-8280. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Advisors 360. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions that you may have regarding your investment planning. ECA does not provide tax or legal advice. Guest opinions are their own and may not reflect those of ECA. The viewer is encouraged to seek their own individualized tax and legal advice from a qualified professional.